Okay guys, welcome. This one is going to be all about a Chinese electric vehicle company called Xiaopeng. Ticker is XPEV. So this one has gotten a ton of attention. It's one of these stocks that's on an absolute meteoric rise. People see it as a baby Tesla. It's kind of an opportunity to get in on Tesla years ago before it had that crazy run up in price. People are super excited about it, getting tons and tons of attention. So I want to do a little bit of an analysis video, get into some specifics of it. Let me tell you what I think about the business.
You have to pay attention to your money.
So it's going to be all about Xiaopeng and their cars. They've got a pretty impressive lineup, but more so than the product, I actually want to get into the specifics of the business, like I said. So we're going to talk all kinds of things. We're going to talk about the current news and what that news cycle has done to the price, because I think the price action lately has been completely driven by the news, which is actually a good story, and I'll explain why. I want to talk about the dilution that just happened. There was a secondary offering of shares. So I'm not sure if everybody really understands what that means. I'd like to explain it and go into specifics of what it actually means to an investor like you. I want to talk about their business model. I want to give you an understanding of how the business operates and how it's structured. I think this is really important to make an informed decision on an investment. You know, you're not just buying a ticker symbol that has a price chart, you're buying a business, right? So it's really important to understand at least a little bit about that business so you can interpret the news, you can interpret earnings and all that kind of thing. And then finally, we're going to talk about the exciting stuff, which is the growth of the business and the growth prospects. And we're going to get into a valuation. How the heck do you figure out what a fair price is to pay for something like this? So the price action, like I said, has been driven by the news. I think that if you look at the chart here, there was a peak in November, and since then there's been a steady trend line heading down. And you know, it's difficult to know what to do when the price is going down like this. 32% drop is a bit much to stomach, especially if you brought in at the top. You know, they say buy the dip, but you can only do that so much. If you keep buying the dip and it keeps going down, you kind of feel like you're losing out. So on the one hand, it looks like a bargain, it looks like a buying opportunity, but it can be painful to try to scale in when this is happening to the price. Now, I think the good news in that is that we're seeing a consolidation in price at this level, right? So this purple line and the blue line, these are called Bollinger Bands. This is a technical indicator that measures the variability of stock price over time. And whenever you see the bands narrowing, it sort of means that the market is finding a new price. And it can mean that it's ready for the next breakout, as they say, which is a new phase in the price action. So there's at least some hint here, I think, that it is finding a new price level, and I think it's poised now for the next move, whatever it's going to be, it's getting ready for it. So what caused this downward run? One thing was a downgrade. UBS actually issued a downgrade. Anytime an analyst does that, it's going to shake investor confidence a little bit, especially in a high-flying stock like this. It's particularly vulnerable to these sentiment-based things like an analyst downgrade. There was a short seller attack on another EV company in this space called Candy Technologies. You know, when Hindenburg went after them, I think it again shook sentiment. They tried to bring some things to light that were fairly negative on that business, and they could have absolutely been correct. You know, I haven't looked into it a great deal, but they could be right in terms of some of the shortcomings in those numbers. And there's always a fear that contagion, you know, could spread to other companies like Xiaopeng. There was another dilution announcement just prior to this from another competitor, Li Auto. Again, same thing, shook investor confidence, drove the price down. There's the whole drama over this delisting bill in the US. I mentioned this in my other video on NIO. And really, I'll say the same thing here that I said about NIO. This is worse than it looks. I think even if the delisting bill goes ahead, it doesn't necessarily mean that anything's going to happen. There's a 3-year period for these companies to try to become compliant, or in those 3 years, who knows what's going to happen, right? I think that politically things could get a little bit more favorable to these companies. And at the end of the day, Wall Street is going to lobby hard to try to make a deal here, to try to get something worked out. There's a ton of big money behind that. I think they'll be able to figure it out. And then, of course, Xiaopeng itself comes out with a dilution event, which, you know, further devalues the stock and makes investors a little bit more wary. Now, I want to talk about that dilution a little bit because, like I said, not everybody necessarily knows what that is. A dilution event is a secondary offering. So you know what an IPO is? The company comes out with a massive dump off the stock on the public market. Everybody buys it up, and suddenly you have that public ownership. A dilution event or a secondary offering is pretty much the same thing, but this has an impact on existing shareholders. So imagine a simple situation where you have two shareholders, and between them they own 50% of the company. If they issue a secondary offering of shares, they don't actually take shares from shareholder A and B. Instead, the company creates brand new shares out of thin air and dumps them on the open market to raise additional capital. So shareholder C will buy those shares. And now, even though A and B didn't lose any of their shares, those shares represent now a smaller portion of the overall company because more shares have been created. So now A and B actually own less of the company. Their shares represent a smaller stake. This is not good news if you're an investor because it means you now own less of the overall pie. It didn't necessarily create more value in the company, it just diluted your holdings. So it's not good news if you're a current shareholder. Well, it's all about raising cash, right? They needed that additional money, and when the stock price rose to that level, they felt as though it was a good time to do it. Just like any other investor, those principals in the company wanted to cash in on the elevated stock price. And like I said, they now own a smaller percentage of the company. If you're a previous shareholder, that's not good news. And at the end of the day, though, it's not uncommon in this situation. This is absolutely what happens in these early stage companies. They need to go through additional rounds of raising financing. I want to talk about what's going on here with the overall company and what they're doing. Basically, if you look at their business, this is a description of what they're up to. They design, develop, manufacture, and market smart EVs primarily in China. I think at some point you're going to see them expand outside of that domestic market, but that's a long ways off. There's a ton of room to grow domestically within China right now. The amount of money that they're spending to fuel that R&D growth is really impressive. It's one of the things that makes XPEV stand out amongst its competitors. Right now they're spending 52% of their revenue on R&D. That's a big, big number. It's actually double, I think more than double what NIO is spending. And NIO is actually further along, at least a little bit, in terms of the evolution than these guys are. So super impressive number. It's a good sign. You want to see companies invest that kind of money in R&D because that's what's going to fuel growth. If they don't have that commitment to R&D into the future, 6 months down the road, 9 months down the road, they're going to fall behind and that's it. So this is crucially important to drive that growth. Another key thing about these guys that's super important to understand is the degree to which they're vertically integrated. They own the entire stack of their business. They own all of their technology. They haven't had to pull in external partners to provide some of that stuff. Others are partnering with external companies. NIO, for example, has a key partnership with an external company to provide their autonomous driving systems, whereas XPEV is actually doing it in-house. So they don't have as broad a reach as NIO does. NIO has owned their entire business, service, retail, parts, charging, battery swaps. They own the whole thing. Whereas the focus here with XPEV is more on the core business. So they're vertically integrated within the core business, within that full stack, and they own all the pieces of that. I think it's a key advantage go forward for sure. So that's the business model. So let's talk growth. What is fueling this growth and what are the numbers behind it? Right off the bat, you look at what they've actually been able to deliver in terms of cars and getting them out the door. Just in the fourth quarter of this year, they're on track to produce 10,000 vehicles. That's absolutely going to meet the market demand. Prior to this, there was actually more demand than production. Production was actually their bottleneck. Folks were absolutely willing to buy more cars than this, and I think now they're scaling up to hit that demand number. And they're doing it by building out additional capacity. So they're building a second plant in Guangzhou. That'll come online later in December of 2022. Now, they actually do have two plants online at the moment. There's one that they own themselves, and they have one contracted from another company. So this is technically their third plant, when this comes online. It's really going to make a difference in the numbers. So, what's that revenue look like? I mean, if they can scale up to this promised number of 100,000 cars a year, that would imply revenue of 3.4 billion, which is pretty impressive. These cars are selling for a pretty good margin, and they're bringing in a good amount of revenue in the door. But the real question is, what does that actually drive in terms of a valuation? Now, valuing these companies is not easy. They don't have earnings, and so when they're this early stage, you can't use a lot of the traditional metrics that we otherwise would to assign a value number to them. Given that, probably the best we can do is to look at a comparable valuation model instead of some of these other methods. We can't use discounted cash flows. We can't use asset base, we can't use sum of parts because they're just too early stage and they haven't really identified reasonable numbers in these, but we can do comparables. And so if you look at what Tesla trades at right now, Tesla's trading at about 18 times projected revenues. NIO is about 27 times. And and the current numbers, Xiaopeng is trading at about 38.5 in terms of a multiple. So you can see what's going on here, right? Tesla is the more mature, NIO's just a little bit more ahead of Xiaopeng, and then these guys are the most early stage. So I think this story is all about the multiple is being driven by where these guys are on the growth curve. And I think that this is actually not an unfair multiple for these guys because the market is anticipating that they have the steeper part of the growth curve ahead of them, right? So they have that really meteoric growth potential that these other two companies have already experienced earlier on in their life cycle. So this is all about the opportunity to get in earlier and experience some of that early stage growth. Comes with a huge amount of risk, right? But for somebody that's willing to take that risk, in theory, they may be rewarded by the rise that follows in the price. So guys, that's my analysis of this company. Do I think it's a good buy? I think it is. I think the key thing is the consolidation we're seeing at the current level. I think it's a reasonable time to hop in. It's still an enormous risk. Could absolutely be a wild ride from here. And I think that's really the one thing that I could almost guarantee you is that it's going to be a crazy ride. There's going to be a ton of volatility. If you want to get in at this level, you have to accept that you could be looking at a very, very steep drawdown from here before you can actually recognize some of that growth go forward. So I think if you have a long-term holding horizon on this one, then I think it's a fantastic opportunity. If you're a short-term trader, though, looking for quick profits, I'm not sure I would necessarily look at it. I think that you could be looking to get stung really badly on this one. But again, if you're willing to ride out a drawdown and invest for the future, I think it could be an awesome opportunity. So I hope that analysis helps. I hope it makes sense. Let me know in the comments what you think. If you agree, if you don't agree, love to hear it. Love to see you give the video a like. Subscribe if you haven't already. Don't forget to ring the bell. That'll give you a notification on the next video, and I'll see you on the next one.